Review of what we've done last week. So there wasn't a lot, so this will be a rather short review. But maybe there are some questions from your side regarding what we've done last week, or still something regarding the course organization, anything unclear that you would like to ask. So whenever you have questions, feel free to approach me. I'm really happy to carve out like a couple of minutes at the beginning or at the end of the lecture if it's kind of a more it's not a short question, it requires a longer answer. Okay, so let's quickly have a look at what we've kind of worked out last week. So we looked at financial instruments. That means these are kind of instruments, financial products issued by corporations. And we focused on basically three things that I think were important that you should know about every financial instrument from a corporation. The first thing was, what are the cash flows that you will get? The second thing is, how much influence do you have on decisions made by the firm? And the last thing was basically what happens when the company gets into trouble. And trouble was basically bankruptcy. We've basically looked at the key properties of equity and debt and also worked out some key differences within those groups. Right. So within the group of equity, we looked at different types of shares, for example, that have different voting rights. The preferred shares do get a little bit of a higher dividend, but they give up their voting rights. And then within the group of debt contracts, we have different contracts with different seniority levels. So subordinated debt is basically the most junior or last kind of seniority. Then you have senior debt, which is usually first in line. But on top of that, you could have collateral, which makes debt even more safe, because you can, whenever there's bankruptcy, you can first take away the assets, for example, real estate, machines, or basically anything that's a tangible asset on the balance sheet of a corporation. And real estate is just really popular because you can basically secure your collateral by basically having the entry in the official registry that's maintained by the courts in Germany. So now let's shift gears a little bit. So that was a short rundown of what we've done last week. I think I would like to skip this discussion here and save it for later, because the question that I would like to discuss with you rather fits into the different chapter better. The rest, what I would like to do in this chapter with you is to tell you what the notation is that I'm going to use throughout the class. So what are the variable names that I choose, kind of what do the subscripts mean, and so on. And we're looking at basically exactly those financial instruments that we have discussed last week. So stocks as representative for equity, and then bonds as representative for debt. And I will use this notation throughout the class and try to stick to this. And this is basically, I think, what the standard is also in the book by John Hull, Options, Futures, and Other Derivatives. So it's very similar to what he does. Yeah, and then the next thing that we're going to do is we're going to think about how to compute returns. It's a very basic concept in finance, so just have a look at the core definition again. But I'm not quite sure if you have all encountered that there's seen this before, that there is an alternative way to compute returns. There's the sort of standard return or discrete return. That's probably it's a simple percentage change, right? It's not magic. But then there is another way, the so-called logarithmic return. And there are a couple of rules of how to compute with these returns that we should discuss. Okay, so just quickly get another pointer ready. And then we can get started. So let's start with stocks. I use the abbreviation S for the stock price. It's straightforward. And in later chapters, S can also stand for the price of an underlying asset of a derivative. So that's kind of a reference asset. So this could be something like the oil price, for example. So commodity prices or stock prices. That's what I generally use. Time is denoted with a little subscript, T here. Okay? So if you write down a timeline, I always write the time on top of the timeline. Time is measured in years, right? So t equal to 0 would be today, t equal 1 would be after 1 year. If you want to like have maybe something like half a year, then that would be t equal to 0.5. So every month would be then 1/12 of a year. So that's how we express time. So in units, the unit of time is years. So time is always denoted with a little subscript. So at time little t, the share price is s little t, and at time capital T, it's s capital T. As I mentioned, sometimes we have the starting point, which is then generally the point in time where we want to compute the value of something or do our computations. So that's little t most of the time, but something that you also find very commonly is that people choose t equal to 0 for today. So there is another small, tiny little detail here which can be overlooked. So there is this little wiggly line on top of the variable s after t years. So this here, that's a tilde. And the tilde basically denotes that this variable here is a random variable. So sometimes I put the tilde, or I try to do it consistently, but I put the tilde on top to basically make you aware that from today's point of view, we don't know what the value of that number is going to be. It's going to be random, right? So from today's point of view, we can observe today's share price, right? That's why there's no tilde on top of it. But in the future, well, it can go up, it can go down. Well, basically we don't know. And there are two ways of treating this. So the first thing is we can just go through scenarios. We can assume, okay, what happens if the share price is at a certain level? And the second one is we assume probability distributions, right? And one distribution that's very commonly used is the normal distribution, right? And we're going to use that, for example, for option pricing later. Well, technically speaking, the normal distribution is used for the return then, and not for the share price itself. The normal distribution is the distribution that's kind of the basis for everything. Yeah, I will review the normal distribution to the extent that you need to know it, and I will show you how to do the computations in Excel, right? You don't have to work with the formulas from the normal distribution yourself, right? We have a computer that does the work for us. So what we typically assume is that you can trade the shares, or as I call it here, underlying asset, so that's the reference asset of the derivative, that you can trade that without any cost. So that's a simplification, obviously, but I would like to kind of start with the most simple setting as possible. We can make it more complicated afterwards, right? So incorporation of trading costs is really just a very simple exercise. Now, there is something special in finance, and that is that you can not only buy assets, but you can also sell assets without owning them, right? So suppose you don't have the share today, maybe it's a corporation like Daimler, you can go to the stock market and sell a Daimler share without owning it. It's a little bit weird, and I will explain you how this works. But first, in terms of terminology, if you buy an asset, buy an asset that's in finance called a long position. If you sell it, it's called a short position. So long and short are the two things that you can do with an asset. Maybe let's first think about how this technically works in real life, and then think about the cash flows coming from this. So I'll come back to this slide in a second. So think about how this would work in real life if you sell something that you don't own. That's quite difficult, right? Suppose you want to sell a car and you don't have it. So you meet with the person buys the car, so gives you the money for the car, and then at some point the person says, well, where's the car, right? So that usually doesn't work out. And I'm not meaning that you steal the car to sell it, right? That's not what the point here is. And the same thing basically works in the financial market. The same happens in the financial market as well. If you sell, for example, a share to another person, the person at some point wants to get the share from you, right? But here's the point. The actual exchange of the share and the money does not happen immediately in the financial market. Right?